Hi guys, so let's now take a look at cash flow and cash inflows and cash outflows. Okay, so a nice little analogy to help you understand this is thinking of this sort of bathtub. Excuse my really crude drawing here, but hopefully it gets the perspective across here. Okay, so we've got inflows coming into the bath through the tap, and then we've got the outflows going down the plug hole here. Okay, so let's have a look at these inflows. Inflows, also known as receipts, of course. So it could be that you make cash sales and you actually get paid up front, or when those goods are actually taken by the consumer, of course. Then you've got credit sales. That's where the consumer buys now but pays a little bit later. Okay, so you may offer 28 days credit perhaps, okay, and that means that they've got 4 weeks to actually pay that invoice. It could be, of course, that you get a loan, and that loan will actually boost your cash flow and help actually ensure that you have cash in the bank or water in the tub there, so to speak. Okay, it could also be that you have capital introduced through owner's capital, or that you have a share sale and that you sell share capital. Alternatively, you might choose to actually sell any unwanted assets or do a sale and lease back on a vehicle or something like that. And that sale of that asset would bring cash into your bank account, of course. And then there's bank interest received, all right? So any savings that you've got may well get interest on them. Any savings the business has, that is, okay, may well receive interest on them. And as a direct consequence of that, then again, that's going to mean money entering your bathtub. Okay, but of course you've got money going down your plug hole as well, and that is outflows or payments. Okay, so the outflows or payments, well, cash purchases where you've had to buy raw materials or stock, credit purchases where you've bought things on buy now pay later basis, okay, and perhaps again you have 28 days to pay those back. You've got rent, okay, you've got rates, rates very similar to council tax but apply to business, wages, a variable cost, of course, of production. The more you produce, the greater the wages will be. Salaries, well, they're going to be a fixed cost, of course. Monthly payments to your workers. Okay, so if you take salary of £24,000, divide that by 12, it's £2,000 every month. Okay, then you've got utilities, so heating, lighting, water, phone, broadband, etc. Purchase of assets, so if you buy any new assets, okay, of course that's going to be a cash outflow. Then there's value added tax, okay, to pay, and bank interest. All right, so if you've got to pay any interest back on any loans or mortgages perhaps that you've actually got, then you've got to pay those back. So overall you get your net cash flow position. Your net cash flow position is simply your inflows minus your outflows, or alternatively your receipts minus your payments. Okay guys, I hope that was useful. Thanks a lot.